Hi everyone, welcome back. I thought I'd do a follow-up on our last video, which was not too long ago, and maybe recap some of what we said then and where we are now. Now, if you remember, during the last video, the market had gone into what appeared to be a very significant correction. We were still in January, and there was a lot of concern as to whether or not things were going to get really bad. There's this chart floating around out there comparing the current market action with 1929. And so the whole world appeared to be coming apart, and we were concerned too. Now, in spite of being concerned, I felt at the time that because of the timing and because of the way in which the market was moving, I felt that experience was telling me that the probability was that although we would have a little bit of a correction here, we would probably go back and retest the old highs before the market made up its mind. And indeed, that's what it has done, right? So it's gone up. Now, of course, between then, which was right here, the last video, and now, the market had a couple of, few actually very bad days, a few days going down a couple hundred points at a time. So as that starts to happen, we have to take the position that although experience tells me this and I believe that, the truth is I don't know what's going to happen. And so as the market begins to be more and more negative, we begin to be more and more concerned, and we begin to take things to cash so that we can create some hedge for you so that you can defend yourself in the event that this turned out to be a really bad correction. It didn't, and in fact, my experience was right. The market is here now, retesting the old highs. If just for a point of interest, let me play back a little bit of what I said. Certainly about mutual funds and on the stocks, I don't know. We could change our minds very quickly on that, so you need to stay close. But my experience is telling me that we're going to get to somewhere between 5 and 7%, and we're going to zig back up and come close to retesting these old highs. That's what I think is as a reasonable possibility of happening. So that's what I said. Now, why? If that's what I felt, then why not just do nothing? Because what I feel and what I think I know isn't necessarily what's going to happen. So I have to always remind myself that I can't time the market, that I can't look forward in time because I don't have a crystal ball. That all I have is what's happening and what has happened, and that every time I feel threatened, I begin to sell without regard for what happens next, because it's the only way I know to try and mitigate as much as possible a 2008 scenario. So we gathered a little bit of cash, and here we are with a little bit of cash, and now we're waiting to see what the market does. Now, what the market does here is really important. It's either going to test these old highs and fail, in which case we are in for a decent sized correction, or it's going to bulldoze right to those old highs and keep going, in which case we'll probably get a little bit of a rally between here and, say, April-ish, May-ish. But if history repeats itself, and history often does, sometime around that period of time the market is likely to go into its typical summer doldrums, and which eventually leads to some sort of correction, which eventually leads to the bottoming out of the market somewhere, let's call it September to November, usually around October, give or take. So we don't know what the market's going to do, obviously, and we don't know what kind of opportunities it's going to give us. What we do know is that we have a little bit of cash in the portfolio, not a lot, but a little bit of cash. And I also know that I'm not going to try and chase this little rally with that little bit of cash because that's doomed to failure. So what I'm going to do is see if the market gives me a correction and settles down and I can put the money to work, or if not, if it appears that we're just going into the semi-doldrums and that we're going to be holding that cash for a long period of time, then we might take that little bit of cash and try to buy some high-yield bonds so that we could try and get some interest paid to us, which is better than money market account. Knowing, of course, that we've increased the risk significantly, right, by buying the bonds, because with a money market account, you're relatively likely to keep your principal, right? Most money market accounts don't break the buck, as they say. But when you buy a bond, there's always the possibility of capital gain or capital loss, and there's always the possibility that we have a capital loss that's sufficient to wipe out any interest we may have been paid. But hopefully, if we can select them well, and if things help, the market helps, we might be able to earn a little bit more than money market account. So that might be a strategy. Another one might be to simply leave the money in money market account. And of course, the third one is we're off to the races, and it looks like we're never going to have a correction again. In that case, we'll put the money back. Spring correction. This is more likely to be an early correction, and we go back at some point and still try to retest some higher levels before we didn't have that typical correction that leads us to October and does this to the market and so on. So I don't think we're there yet. I think we are in a tradable market. And I think that we need more information. We need more of this market to show itself to us before we can actually make a decision. So, given that, we're back in one of those positions where we don't know exactly what we're going to do, but we will do whatever the market tells us to do. I just thought it'd be interesting to follow up on the last video, only because it feels kind of nice to know that, after all these years, I've seen some of these things before, and experience does tell you something, even though most of the time you can't use it. So stand by, and let's see what we can do from here forward. And thank you for your time. Take care.